Now let's look into other disclosure requirements in respect of property, plant, and equipment. The first point is the existence and the amount of restriction on the title in respect of the property, plant, and equipment that are pledged as securities for liability. Sometimes businesses go to banks. They raise money from the bank as loan, and in return they give security. They give security of their property, plant, and equipment. If the entity is not able to pay the debt, the bank will come and take the ownership of the property, plant, and equipment. So there's a restriction in the sale. There's there is definitely a restriction in the sale. You won't be able to sell the property to someone else. This is what we call it a restriction on title, and the entity is required to disclose the fact regarding all those property, plant, and equipments in respect of which they have a pledge. The second point they need to discuss is about the amount of expenditure recognized in the carrying amount of a property, plant, and equipment during the construction. If the amount of expenditure that they have recognized or they have included in the carrying amount of any property, plant, and equipment during the construction, they need to provide a disclosures of this. The third point would be the amount of the contractual commitments for the acquisition of property, plant, and equipment. Sometimes entity may enter into a contract and they would say that I will purchase, suppose, $100,000 of property, plant, and equipment every year till 2020. So they need to make these kind of disclosures so that investor would be able to understand the commitments that they have in for the future. If it is not disclosed separately in a statement of comprehensive income in respect of the compensation from the third party that received in respect of an impairment lost item in the P&L. Sometimes what happens is businesses make general insurance. They pay premium for the general insurance in respect of the property, plant, and equipment. And if anything bad happens to the PP&E, then they get reimbursed from the insurance company. These should be recognized as a separated transactions, and these transactions warrant disclosures in the notes to the financial statements. So these are few of the general disclosures that are applicable for all the property, plants, and equipments. Now let's move on to those property, plant, and equipments which are revalued or for which the entity have used the reval model for subsequent measurement. The first thing they need to disclose is the effective date of revaluation, when they made the revaluation, because it's very important for the user to understand the scenario as on the date on which they made the fair valuation, or how fair valuation is recent. They can gauge this from the date. The details of the independent valuer who has valued the property, plant, and equipment, because it should be done from a reputed firm and the disclosure need to be provided. As we are making a fair valuation, the disclosures covered by IFRS 13 will also come into picture. So I'm going to just give you a brief highlight on what are the disclosure generally covers under IFRS 13. Basically, the entity required to classify in all the items that are fair valued at either level 1, level 2, and level 3. Based on the quality of the fair value, they have three levels. Along with their table, they need to provide these disclosures. So these are major disclosures that covers under IFRS 13. There are a lot of disclosures, but these are some of the common disclosures. For each of the revalued property, plant, and equipment, the carried amount that would have been recognized if the asset would have covered at cost or carried out at cost. Suppose I am carrying the asset at fair value and the carrying amount is $100,000. And if I would have carried the asset at cost, the amount should have been $10,000 only. Now you can understand the difference, right? The difference in the fair value is $90,000. So the users of the financial statement can understand that whether the fair valuation itself is valid or not, or whether there is any justifiable ground for a 90,000 markup over the cost. The revaluation surplus indicating any restriction on the distribution of the dividend to the shareholders. We already discussed about the concept of revaluation surplus because when we revalue anything on the upward side, the revaluation gain will go to the revaluation reserve through OCI. So basically, the entity is required to provide disclosures in respect of the revaluation surplus. So now let's move on to some other requirements. The carrying amount of the temporary idle property, plant, and equipment. Sometimes the entity may not use all the property, plant, and equipment, and it's the user's money, it's the shareholders' money that they are investing in the property, plant, and equipment, and shareholders have all the right to understand the PP&E that the entity is not using. So they can ask questions like why it's idle, why you are not using it, you do not have any project. If you do not have any project, why you bought it? So a lot of questions are thrown at the management during the annual general meeting. So before that, these disclosures should be there in the financial statements. The second part would be the gross carrying amount of fully depreciated property, plant, and equipment that is still in use, which means these are danger. These are very dangerous PP&E because they will definitely warrant for a replacement. They will definitely warrant for a replacement. We've already depreciated this much amount of assets, and we've already depreciated an asset completely, but still we are using it. First, it will have a doubt over our estimation of useful life and the depreciable period over which we depreciated. Second, the users will get to know that there is a definite requirement for a capital expenditure in the near future, and they can ask management what's their plan on replacing this asset. Basically, they will ask the funding requirements. The third point will be the carrying amount of PP&E retired from active use and not classified for held for sale. If you are not using the any property, plant, and equipment, why you are keeping it with you? Why you are keeping it with you? If it is out of the active use, sell it, because the price or the value of property, plant, and equipment decays over the period of time. So if you are not using any PP&E, I'm not saying it's idle, it's out of active use, which means it is retired, it's redundant. Then why don't you sell it off? So these disclosures are required to be provided in the notes to the financial statements. If the entity is using the cost method, the entity is required to disclose the fair value of the PP&E if it is materially different from the carrying amount. Let's think the other way around. Suppose the carrying amount of the PP&E is $10,000. However, the fair valuation is $100,000. They need to disclose this fact to the shareholders. Okay, look, whatever you are seeing in the financial statement, it has a lot of value. Or suppose the cost of the asset is $100,000 that we are carrying in the books of accounts, but whose fair value is only $5,000. It's materially different, right? 95% of variation. It's both ways. It's not the only one way, it's both the ways. If it is upward or a downward, if there's a gap which is material, the entity is required to disclose. So in this two videos, we discuss about the disclosure requirements. That's our final touch up on IAS 16 as a standard reading. So I hope you enjoyed the disclosure requirements and other sections of IAS 16 as well.